most important thing, though, to do is that you have to tell the bank. Now, how do you think a real estate agent is going to tell the bank that there's an investor buying the house? How would and that the investor, by the way, is going to lease the house back. The investor is going to buy the house and lease it back. So solution number 5 will be to do a short sale with lease back. Okay, we know that's the best solution at this point. Lease back. Now, how does the realtor present that to the bank, tell the bank that that's going to happen? What do they do? Does anybody know? Okay. What they do is, in the offer that's made for the property, about 2 pages into the offer, there's a block that's checked. It's a standard agreement from California, standard agreement in California that says lease back option. And you can check that block. So when the offer is made by the person buying the house, by the investor, the realtor has to make sure that block is checked. As soon as you've checked that block, when the bank receives the offer and they review that offer, their job is to read that offer, everything. Their job in underwriting is to translate that offer to an escrow. When they see the offer and it says leaseback, that's when they qualify that buyer as an investor. They put that in that category because they know it's an investor because they're leasing it back to the owner. Now, why do you think the investor would buy the house and lease it back rather than just simply buy a house and just rent it back to somebody? Anybody. What's the advantage of leasing back a house to the person that's in the house?
You will get a sure buyer there.
You have a sure renter, don't you?
Sure renter.
They're not going anywhere.
But they will have the chance to buy it.
Yeah, from their view, they can buy it later.
Yeah.
Now,
what
here,
about the payment and the price? Is that lease back with the option to buy back?
Now, here is something we have learned, and they're still working on this, and we're working with the California Association of Realtors to know more about how to do this. But there's a thing called flips. Banks do not want investors to buy and flip back to the seller. Now, why do you think that might be the case? Flip meaning they're going to buy it and sell it back to the seller, right, to the owner. Why do you think the banks don't want that?
Well, they don't want the investors to make money.
Yeah, because everybody would do it, like now, right? I mean, if I can you buy my house, you're going to buy it. As soon as you buy it, a month later, I go back in escrow, I buy it back from you. I get my house back, and the bank loses $200,000. Why? The bank does not want that to happen, so they have regulations about flips. They don't want that flip. If you do a lease with an option, even though it's not 1 month, even 1 year, it still becomes a flip. It's just a 1 year flip. 1 year buyback. However, so it would not be correct at this point. It would not be correct to do a lease back with an option. Your person that you're going to invest in you and your property, they're going to lease it to you. You have to work out in a year's time what you want to do with that investor. That's between you and the investor. However, it means no matter what, you get to stay in your home, you don't have to move anywhere, and in a year, if you still can't work anything out, now keep in mind he's probably going to want his money, so he probably is going to want you to buy it anyway, but let's say in a year you can't work it out, you then can go find another house, because in a year or 2, your credit will finally come back up again, and you'll be qualified, because the regulations are right now, with an FHA loan, you can buy a house in 2 years after a short sale with an FHA loan, with a 3% down, but you got to wait 2 years, okay? 2 years, right? So you'll be ready to buy a home again, whether it's conventional or FHA. You can buy a home in 2 years, and you do not have to move. So if you're facing a situation where you're $200,000 upside down in your home, and you're making payments twice what they should, okay, the best thing you can get is which one now? Number 4. But nobody gets it. If you could get it, you'd stay. It's over. You can't do that, at least at this point. So the next best thing is a short sale with a lease back. You don't move, you stay, in about a year to 2 years, you work something out with the investor and buy it back, which I'm sure he would want to do. He doesn't want to keep your home, he wants to go buy another one to make some more money, usually. So,
What is the requirement on that investor, Mike? Do they have to pay cash or can they go get loan from Bank of America too?
any loan, well, any bank they want. Bank of America doesn't, it is not a, they don't have a requirement as to what bank. Any convention, they don't care as long as they get their net. As long as they get the amount that they believe they're supposed to get. Now, what would you think the amount be now that you said, okay, Mr. Investor, I'm going to go ahead and take your offer here. And I want to stay in my home for at least 1 year, or you can sign a 2-year lease if you want to. That's up to you and the investor. You can specify how much time. 5 years if you want to. Of course, you won't own the house during that 5 years. You may want to buy it sooner. But you can sign a 5-year lease. Your payments drop in half. You stay. You don't go anywhere. When you're ready to buy, you either buy that house or buy another house like it when you're ready to buy it. And then you don't have to move. So it takes all of that stress, all of those problems that you have when you have foreclosure and all of those other things, they go away. Now, so why would the investor buy that house and put them there? Because nobody wants to leave their home. Remember, the whole reason for doing this in the first place is to stay in your home. And that's why the investor knows that you're doing this. So it's perfect. You're going to stay there. Not only are you going to stay there, you're going to take care of your home because that's your home. You're not renting the home. You live there. You've been there. So you're going to take care of your home. Now, there is one other thing that I want to mention when this happens. When the short sale package is done at the bank, they require that the seller of the home, who has the money to pay those payments, they have to submit to the bank their banking statement, their personal banking statement for 2 months. They have to show them their pay stubs. They have to show them their tax statements. They have to show them a complete financial package that shows exactly what they make and what they've been making. This same package is also given to the investor. Now the investor not only has an opportunity to lease a property to somebody, more than just a renter, but he's going to see the complete financial condition of that person. He's going to see their checking statements. He's going to see their tax statements. He's going to see that they pay all their bills. So that's the other reason why the investor says, yes, I'll buy this house. Because I know that they have this financial package. They can make these payments. They just don't want to pay twice what they're supposed to pay, what they would want to pay. So then again, just to recap real quickly then. So we had, in the beginning, what most people see is just what you said today. Just what you had said today, which is number 1, 2, 3, and 4. Short sale, bank foreclosure, loan modification with just the interest and payment reduction, and 4, loan modification with the lowering of the principal. Those are what everybody basically understands. Now, there's a 5th proposition, and people are doing it, where you can do a short sale and lease it back, and you tell the bank, and they qualify it, and they say yes. They may ask for the seller to pay money. If the seller has an income and they can make the payments, they're going to tell that to the seller, especially if the seller has not paid for a year. They're going to want that money because they know by looking at the financial statements that for the last year they didn't make their payments, but they had the money. They should have made the payment. So they will ask. But think about this. When I always explain to the seller at this point, the owner of the property, sir, you wanted to reduce your principal payment. You want to reduce your principal, is that correct? Yes. You want to reduce your amount you pay every month by half? Yes, okay. Now, if you pay the $12,000, which are, in this case here, they ask for $14,000. If you pay your $14,000, you stay in your home, you didn't have to pay it this year, so you're actually only paying on a 12-month basis, you're only paying $1,200 a month and your payment was $25,000. You already reduced your monthly payments by half for this year that you already were here. And they're going to be half for the rest of the time you're in the house. So, you got what you wanted. It's just not a loan modification, but you got what you wanted. So then they don't feel so bad about having to give up money. Because sometimes they say, well, no, I don't want to pay because I'm selling the house and I don't want to pay. It's okay. If they think about it for a while and they realize, okay, if I don't, the house will either be foreclosed and I won't qualify. By the way, if they have the money and they can make the payments, they do not qualify for number 3, the loan modification. They will not qualify, or nobody gets number 4 anyway, They're not going to qualify. The only thing that they can do, if they have money and they get it every month and they have an income, they can only do bank foreclosure because they're not paying, or they do the short sale. That's all they can do if they have the income. What we're saying here today, that's why I wanted to make sure we had this workshop, is they definitely can do a short sale with a lease back. And it's legal because you tell the bank. It's up to the bank to decide what they want to do. It's their decision, and they are doing this. Given that in mind, that they want to stay in their home and reduce their...
Short sale is still the market value, man?
Short sale, yes,
value.
yes. Yes, the short sale will be at fair market value, but because it's an investor, they expect to get a bit of a discount. They understand that. And Bank of America does give discounts. Here's a good example. We have a house, and there's a realtor. The broker is in this audience today. I won't say his name because I won't discuss his business, but there's a broker here today. And in that broker has a listing. That listing is in a very nice area here in Stockton. The listing, the house value is $395,000. $390,000, $395,000. The house across the street from where this present listing is just sold a month and a half ago for $399,000. It only was 400 square foot bigger, didn't have all the upgrades, so it's basically the same house across the street for $399,000. Wells Fargo Bank just approved a short sale on that house. I can say Riverbank because it's just a street on Riverbank for $340,000. So they're going to save $40,000. Now, an investor's not buying it. It's going to be somebody who wants the house. It happens to be somebody in the neighborhood who wants the house. They want to move from their house over to the other house. That's all. But an investor, it would be a great opportunity for an investor because immediately on the buy, he will get $40,000 equity, at least. Maybe 50, but I say 40 for sure. Now, how do you determine the fair market value? As realtors, you know that you get a report that shows all the houses that have been sold in the area for the last 6 months. So you know what the value of that house is. The bank does an appraisal. They know what the house is. And they still did this because it was approaching a trustee sale and they needed to either sell it or foreclose it. They said they will take the money. So yes, the answer to the question is generally they want fair market value. And everybody's going to know what that is. It's whatever it's appraised at. But they know it's an investor, so they will take less, and that's the other reason why they tell the seller of the house that they want some cash from them too. Because the investor's getting a discount, they're going to stay in their house, the bank says, you should give us some money too, because we're losing a lot of money, and they'll do that, okay? So that's a good question.
So you arrange the lease back outside?
No, it's in the offer. No, it's in the offer.
Yeah, I know, but you have to wait 1 year to make a deal on the buy option.
Well, from my point of view, of course, I'm just an agent, so I don't have the last word. But as I see it, once you enter into a relationship with your landlord, and he's leasing his property to you, okay, you can do anything you want to do with that landlord at any time. You can amend the lease, you can buy the house from that landlord. It's your relationship to him. You just can't do it before the sale. You can't make that kind of commitment before the sale. But once you've entered into the relationship, he's your landlord, you're the tenant, then that gives that opportunity no matter what, right?
Yeah.
Right? Because he's the landlord, you're the tenant. If he wants to just give you a discount on the rent, that's his business.
The landlord, though, will be in control how much money.
Yeah, it's up to him. Now, however, remember the lease. Now, this is the second part of that. When he if in fact you buy it back, what would you think you buy it back for?
Maybe 10% more.
Maybe. Now think about this though. When I work with clients and the investor, I explain to them that the client normally does not have the cash, or they wouldn't be in a situation quite like this anyway, but normally they don't have, most clients have to borrow money to buy houses. They have, and they're going to have so much down. They're going to have closing costs, they're going to have so much down. They normally don't have an extra $50,000, $60,000 to work with normally, okay? Now, if that's the case, it seems reasonable that what the investor would expect is he would sell it at whatever the current market value is, because that's what the buyer can afford to pay, because he has to go to the bank to get the money. The bank will not lend more than what the value is. So if the owner of the house says, no, you have to give me more, The buyer won't be able to do it because he has to go to the bank to get the money. The bank will not lend him the money. That's a problem. However,